Indranil Pan, Chief Economist at Yes Bank, joins in. Indranil, hi, it's Samina joining in. Let's start with what have you made of the sharp decline in the GDP number? Are these trends cyclical in nature or an indication of a deeper structural issue? And also, what do you expect in terms of the RBI's reaction to this? Still a rate cut expected only in Feb, or the odds have increased now of a cut in the next week?
Hi, good morning. I think, yes, the GDP was a bit of a shocker for all of us. In fact, our estimate was one of the lowest in the market at 6% GDP growth, and the GDP numbers have even been lower than the 6% at 5.4%. So if I were to call out two things, on the production side, the manufacturing sector seems to be doing quite badly in this period and is indicative by the fall in the profitability of the companies. But more important for me to call out is the personal consumption expenditure, which was much lower than the expected growth. Now, there could be a couple of reasons for that. One is the Pitru Paksh, which led to a decline in the demand. The other is, of course, the significant amount of heavy rainfalls across the country in August and September that could have sort of derailed the consumption pattern. But however, having said that, there are both cyclical and structural elements in this growth pattern. Cyclical, as I said, the festive demand and the Pitru Paksh and the fall in the demand on that. So from that perspective, we see some amount of uptick happening in October already, which was the festival month. And most of the advanced indicators that we see are positive during that month. On the other hand, from the structural perspective, I think wage growth, or the real wage growth in both the urban and the rural sectors, have been on the lower side. And that is likely to be sort of pulling down demand to a certain extent. Apart from the fact that the RBI has been consistently sort of trying to bring down the CD ratio and had been pulling down the unsecured loan growth because they had increased the risk weightages on these some types of the unsecured loans, and that is also likely to have a negative implication on the demand side story. In terms of the RBI, I think we were talking about a 50-50 chance in February. The probability of the cut in February has increased. We don't see anything in December because in December, the RBI is working with a 6.21% of a headline CPI inflation as of the last reading, and this possibly does not make the right instance where they can actually reduce the rates.
I just have one more question. While you don't anticipate an action in December, could there be a CRR cut in order to manage upcoming tight liquidity? Do you anticipate that?
So first of all, I think the Q4 anyways is relatively tight on the liquidity side. What has made the situation slightly tricky for the RBI is the very fact that we have global risks playing through, which has led to a significant amount of FX sales from the RBI. Our estimate is about a $20 billion sale from the peak level, which is tightening the liquidity to a certain extent. Now, I don't think CRR is the right tool because it provides a durability in terms of the liquidity infusion. And most of the central banks, including the Reserve Bank of India, had been trying to move out of the balance sheet expansion during the COVID period. And the Reserve Bank of India has actually managed to bring down the reserve money growth and the money supply growth to that extent. And therefore, it will be counter to these actions. First of all, the RBI obviously will try to manage the liquidity situation through the VRR and the VRRR and adjust the liquidity at the margin. And if there is a significant stress that continues, rather than a CRR, I would actually sort of want to see the RBI move on the open market operations, open OMO sales to contain the liquidity pressure, OMO purchases to continue to address the liquidity pressures in the market.
Okay. Indranil, thank you so much. It's interesting. I'll keep an eye out for the CRR action or lack of it thereof, because you are one of the rare ones who is saying no action. So we'll watch out for that. But thank you so much for joining in today and giving us that view.